Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a valuation expert and divorce mediator in St. Louis, Missouri. Today, we will discuss how to find hidden assets and or understated income in divorce cases with Leah Wietholter, a forensic accountant, certified fraud examiner, and private investigator in Tulsa, Oklahoma. What was one of your craziest cases where you found the hidden assets and it was just, you just told a different story, but do you have any other kind of crazy case that you could shed some light on?
Yeah, so the case that I think is the craziest is actually related to understated income, not necessarily something hidden. I'm trying to think I think we might have found a few bank accounts, and so then that increased the balance sheet a little, but it was really an understated income because both spouses were successful, had their own profession, and they're both very successful and just kind of ran their thing. And then somebody decided, one of them, I don't remember who, but one of them decided to file for divorce. And then each of them are trying to get the other's money. So, no, I didn't do the best. You did, right? And then
Right.
no, you didn't. And so they're just trying to reach across and grab some out of the other's purse or something. And so in that case, I was looking at the spouse I was investigating had, kind of that serial entrepreneur, lots of management companies, different year ends, all of this stuff. And so the valuation expert said that it was worth about $50,000, that this whole conglomerate was worth $50,000. So of course my client is saying there is no way. I know how we live. I know how he lives. I know how he spends. That is impossible. So we ended up with about over 3 years, I believe. We had about $30 million of transfers between all of his bank accounts. And so that's just $30 million being reused. Right. But we had, I guess about 10 million a year, but being reused. But it's just like going back and forth. And so I teamed up with the valuation expert. It was their lead. And so then I came in to help. And I just said, what if we put everything on the same year end? And we essentially do what I've talked about several times on this episode. We look at where did money come from and where did it go, but put it on the same year end so that it doesn't matter if it was deferred for tax purposes or whatever. Let's see how much money was really recognized in each year. And then let's pull out, the valuation expert wanted to look at what was the benefit to all of the owners. So once we identified all of these transfers, because they had included some of them as revenue on certain, and I can explain that. So with the different year ends, it would be recognized as revenue on one company and an expense on the other. But by having the different year ends, it wasn't being recognized in the same year. So when you put all of these companies together, it's just like this timing difference. So that's how they were getting such a low valuation, which for tax purposes, this was really beneficial, going back to, this is why he set this up. But whenever it comes to divorcing and the value of this asset as part of the property settlement, that's a different story. So once we did all of that and the valuation expert did what he did with the benefit to the owners, we ended up with a $1.5 million valuation. And the judge granted it. The judge agreed with our valuation.